What is a USDA home loan for a house? Well, I'm glad you asked. Rather than a comprehensive review of all of the guidelines in video form of a USDA home loan, I thought it would be better to just explain what the top 5 things I think you should know about a USDA home loan and why you might want one. Welcome back to the channel. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage or home financing, you're in the right place. Subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or get connected to a great real estate agent, scroll down, find our contact information in the details below, or feel free to leave us a comment. We'll be down there getting answers to those questions ASAP. Now, let's jump into the top 5 things I think you need to know about USDA home loans. And we're going to use a conversation I recently had with Jill. Number one, and probably the one you're already aware of, is that USDA loans do not require a down payment. This is pretty awesome. There's really very few programs out there that allow you to buy a home without bringing some sort of down payment, and USDA is one of those. Most lenders will work with you if you have a score of less than 640, but you're going to need some compensating factors such as maybe a lower debt to income ratio or maybe a lower loan to value. And honestly speaking, with a score of less than 640, it's going to bring into play a manual underwrite. It means a human is going to look at that with a fine tooth comb. Generally speaking, and whenever possible, it's best if we can lean on the automatic underwriting tools rather than having a human underwriter go through your loan application with a fine tooth comb. So let's bring Jill into the conversation here. She is a potential client I recently had a conversation with, and turns out she doesn't have savings for a down payment, but she has a really strong credit score. So somebody with a credit score in the 700s without a down payment might be a great candidate for USDA home loan. So the number 2 thing I think you need to know about USDA home loans is they're only eligible in specific locations. Now, if you look at the United States on a map, you're going to find that the metro areas are pretty small relative to the rest of the country. The USDA home loans, generally speaking, are valid for everywhere but the metro areas. So the USDA has a great website where you can enter a property address and determine if the property is eligible for a USDA home loan, or you can lean on your lender partner to do that for you. So it turns out Jill was interested in a home in Jerome, Idaho, which is about 10 miles outside of the Twin Falls metropolitan area. And turns out the specific address that she's interested in is eligible for a USDA home loan. Let's move on to number 3, which is eligibility based on income. But not only do USDA home loans have to be within a certain geographic area, and they provide you the opportunity to not have to bring a down payment, but they also have an income ceiling. So most of the time, the income ceiling is going to be 115% of the area median income. Additionally, USDA home loans have the strictest debt to income ratios really of any loan that's out there. So generally speaking, you have to have a front end ratio, which is your housing ratio. So your principal, your interest, your taxes, and your insurance plus HOA dues, and you divide that by your gross monthly income. And for USDA home loans, that's got to be 29% at the most. And then your total debt to income ratio, your back end ratio, often referred to, is your housing plus anything else that shows up on your credit report. So that would be things like car payments or student loans or minimum credit card payments. When we add that to your potential housing payment, we need to have a back end ratio of no more than 41%. So it honestly is a little bit tricky to qualify for the USDA home loan based upon income. And that's because you have to make enough income to have a low enough ratio, 29 or 41, like we talked about. But you can't make too much income such that you're outside of that top limit of the 115% of the area median income. So rest assured, you're not expected to have to calculate your ratios yourself. That's why we're here to help. So going back to Jill's story, she landed right smack dab in the middle. So she had strong enough income that she was able to qualify for the tighter debt to income ratios of 29% for housing and 41% for total debt to income. But she also had less income than the ceiling, right? So her income was strong enough to qualify, but it also wasn't too much that she didn't qualify.
Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below.
All right, so moving on, I think the 4th thing that you need to know about is mortgage insurance. So most loans are going to require some form of mortgage insurance when you have less than a 20% down payment. Now, USDA is no different. USDA has very affordable mortgage insurance, and USDA's version of mortgage insurance is very similar to FHA's, meaning there is an upfront portion of your mortgage insurance. For USDA, that's 1%. And that amount is able to be financed into your loan amount. So for example, if you had a $100,000 loan, you'd have a 1% upfront fee that could be financed into your loan. So instead of borrowing $100,000, you'd actually borrow $101,000. And then your monthly payment would be based on that $101,000 loan amount. Additionally, USDA charges 0.35% of your loan amount per year. So if we take that loan amount and we multiply it by 0.35% and then divide by 12, that will give you your monthly mortgage insurance that will be required for a USDA home loan. So let's go back to Jill's scenario. She was interested in a home that has a purchase price of $200,000. So in her circumstance, right, $200,000 with the 1% upfront fee would be a loan amount of $202,000. We then would apply the 0.35% on that $202,000 loan amount and then divide by 12. So it turns out her monthly mortgage insurance will be about $58 a month. And that is about $33 cheaper than if she was going to buy this home using an FHA home loan. All right, let's jump into the fifth thing I think you need to know about USDA home loans, and that they have specific property requirements. So number one, you can only use a USDA home loan to purchase a primary residence. And this is similar to both FHA and VA. In other words, if you're looking to buy a second home or an investment property, the USDA home loan is not the right product for that. You're likely going to have to get qualified for a conventional home loan. So homes that are financed through the USDA home loan have to meet minimum standards for health and safety. And this is really similar, honestly, to what FHA and VA loans require. So we're going to have an appraiser come out to the property, and the appraiser's job primarily is to determine the value of the property relative to other properties in the immediate location. But they're also looking for glaring deficiencies of the property's condition, right? So broken windows or missing shingles or a heating source that's missing or doesn't work. Or maybe there's substantial cracks in the concrete driveway that are going to create a tripping hazard. Maybe there's a missing railing on a stairway, or maybe there's an elevated back deck that doesn't have a railing, right? So all those would potentially pose health and safety concerns, and they're going to get called out by the appraiser as part of the report. So they'll deliver the report with a value, but the report could potentially be subject to the repair or mitigation of whatever conditional problems they see in the property. So nothing to be concerned about, but just something to be aware of. All right, so jumping back into Jill's story, the home that she's interested in Jerome, Idaho is actually built in 1930. So that in and of itself might give you a little bit of pause to be like, I wonder if there's any health and safety concerns. Well, turns out that home's been really well maintained and actually recently updated. So the pictures on the listing show a new kitchen, show new interior paint, show kind of generally a home that's been updated very recently. So long story short, I believe that appraiser is going to go out and view that property and say, hey, this home is in satisfactory condition. The value is X and there are no repairs needed. So in the event the appraiser noted something that needed to be repaired, that would actually have to be done prior to closing. And typically that repair is going to be completed by or paid for by the seller of the home. All right, so let's wrap this up. We've talked about number one, no down payment required for USDA home loans. That's awesome. We talked about number two, that the property has to be an eligible location, meaning outside of a metropolitan area. The third thing we talked about was income limits, right? So you have to make enough income to have low enough ratios, but not too much income that you're over the limit. The fourth thing we talked about was mortgage insurance and how it's similar to FHA, but it's actually a little bit cheaper. And then the fifth thing we talked about is the condition of the property and the fact that you can only use a USDA home loan to purchase a primary residence. So long story short, the USDA home loan is a phenomenal product, especially for those that are interested in buying a house without making a down payment. So as we discussed, the parameters for qualification can be a little bit tricky, specifically the income qualification, right? You have to make enough money that your ratios are low enough, that 29 and 41 we talked about. And remember, you don't have to be an expert to be able to calculate that, but you also can't make too much income that you're over the limit. So it is a bit nuanced for the properties and the situation where the USDA home loan can be used. So going back to Jill's situation, she's interested in a property that's eligible, her income fits, and we believe the condition of the property is going to be sufficient. So long story short, USDA is probably going to be a great fit for Jill. If you'd like to learn more about the USDA home loan or have specific questions that maybe we didn't cover for you today, please don't hesitate. Scroll down, find our contact information in the details below. Leave us a comment. Like I said, we're going to be down there answering those questions regularly, and we'll see you on the next video.